Time for Money Tuesday, and if you're ever in a position where you need cash and have assets to sell, we're on your side with financial advice on the best way to avoid digging a deeper hole for yourself. Joining us to explain is Marshall Clay with the Welsh Group. Good morning, good to see you.
Hey, good to see you.
We know a lot of retirees can sometimes fall into this position where they need money for various things that could come up. What should they keep in mind?
Yeah, so this has really come to the forefront of the last couple of weeks with the regional banking crisis that we've seen. And this is at a banking and a corporate level, they put themselves in a position where they had to meet a cash flow need through the selling of assets that were temporarily down in value. And so that's an important thing that the retirees need to think about, because they have an ongoing cash flow need themselves. Mm-hmm. So there's a couple of steps that you can take, and I think the first one is just making sure that you have safe and secure liquid cash set aside for at least 6 months. And so we've talked about in the past, we've talked about setting aside 6 months of emergency cash for emergencies. This is in addition to those emergencies. So ideally you want to have at least 6 months to a year in cash equivalents. We talked about those money market mutual funds a couple of weeks ago that are currently yielding between 4.5%. That's a good place to start building that 6 months of ongoing cash flow need. Secondly, we talked about, we talked a lot about diversification between asset classes. So we talked about the difference between stocks and bonds and other asset classes. And the key here is you want to make sure that you understand the response function of those different asset classes. Typically, those asset classes respond differently in different market environments. That's not always the case as we saw last year. We saw last year both stocks and bonds were down fairly dramatically, so that's not always the case. And that kind of leads me to my third point, is that not only is it important to diversify between those asset classes, between stocks and bonds, but diversifying within those asset classes. So within the bond asset, within the stock allocation, it's important to have diversification. And so I think when you're looking at bonds, you're looking at the length, so how long you are lending money to certain borrowers, mm-hmm. and then the credit quality of those borrowers. So you want to have really high credit quality borrowers, and typically you want to have at least some shorter duration bonds, some shorter term bonds, so that you can liquidate those in a moment's notice. And then obviously with stocks, we're talking about sector diversification and then having a bias towards quality. And what I mean by quality, because people throw that term around a lot, is you want to invest in a lot of companies that make money consistently year in, year out. That can generate that free cash flow that's going to keep their stock price high, and ideally they'll pay a dividend, which helps you in that cash flow need on an ongoing basis. So a lot to think about there.
Obviously some complex things for those who are novices to that, but you can get professional advice on that if you need to. But either way, it's a good message for all of us. Try to get that emergency fund built up as best you can.
Exactly. This is really about portfolio positioning and how your assets are structured. So if you're concerned about, look, I don't know if my assets are structured appropriately, and I don't know if I'm about to run into a brick wall and maybe have to sell some assets when they're temporarily down. If you're not confident in how those assets are positioned, it may make sense to seek out professional help.
All right. Marshall Clay with the Welsh Group. We appreciate it. Thank you.
Oh, you're welcome.
All right. It is 7:47. We're going to take a break. Be right back.